Despite all of the risks, and there are lots of them, I think the world economy is performing reasonably well. And though I see no bargains in financial markets, I think careful investors can still find assets that are not actually overvalued. I'm Giles Keating, and I'm here to discuss the world economy and markets with my colleagues on the Werthstein Institute, Valerie Plagnol, Stefan Risser, and Christine Shields. Why do I say the world economy is okay? The US is growing around 2.5%. That's not bad. Consumer confidence is high, auto sales are rising, so is general retail spending. Consumers seem at last to be stimulated by the collapse in oil prices to below $50, and positive inflation allowed the Federal Reserve to start raising interest rates last December, though the pace is glacially slow. Europe is also growing, though as usual slightly slower than the US. Consumer demand's on the increase, the drag from fiscal austerity is largely finished, Spain's recovering strongly from the earlier slump, and the European Central Bank has pushed interest rates deep into negative territory and accelerated its bond purchases. The UK economy is at risk from Brexit, though lower interest rates can help a bit. Perhaps the biggest risk is political if exit fever spreads. The first test was in Spain 3 days after the UK, and voters went for stability. But there are more tests ahead. Austria is next. On China, investors had major spasms of fear twice in the last 12 months. But the authorities added stimulus and the economy kept moving. However, the debt overhang hasn't gone away. So the world faces risks from factors like debt, Brexit and China. But on the positive side, monetary policy is actually stimulative. New technologies offer enormous investment opportunities, and there's plenty of spare labour. I think the positives outweigh the negatives, but it will be a very bumpy ride. Turning to stock markets, after all the volatility this year, is it a good time to invest? The prices of US companies, shown on the upper line and expressed as a ratio to their earnings, are only just above their historic average. And German companies on the other line look slightly cheap. Of course, there's only one kind of indicator, but it's simple and it's widely used, and it does suggest this is not such a bad time to buy equities. What about bonds? Well, yields are low, not just in Germany, but across the Eurozone. 2-year government yields on the lower line are now negative, and 10-year yields on the upper line are around zero. In a historical perspective, that's crazily low. You can still get higher yields from private companies and in emerging markets. Those have credit risk, but in a world of such low interest rates, some of them do offer reasonable value. As 2016 unfolds with the US presidential elections, Brexit, and investor angst over China, there are plenty of triggers for volatility. But looking through shorter-term moves to the bigger picture, global stock markets seem to trade around fair value, and there are some opportunities in fixed income. I think this gives scope to build a sensible, balanced investment portfolio. Let's see what the panel thinks. Valerie, would you like to begin?
Giles, I cannot agree more. I think there are opportunities. One has to be very selective. I do believe growth is still there, and the underlying trends of these new technologies, structural reforms that are also taking place in some countries will provide for the kind of growth we will be looking for, and it's steady enough to continue to provide for some profits. Of course, if you're looking for the pre-crisis levels, then you're out of the range, but that's not what we're looking for.
Stefan.
So I think equities in general are too cheap. So you mentioned the PE pricing model, and I agree with you that's on historical levels, but I think in our times you cannot just look on the PEs. You have to put into the valuation model the interest rates. And if you do this, there are some models there around, equities are horribly cheap. So there are less of alternatives to invest. And so I'm very optimistic that especially shares, stocks with high dividend yields will grow enormously the next years.
Stefan, that's a very good, even more optimistic than Valerie. Christine, what's your feeling about this?
I'm taking a rather different perspective, I'm afraid. I'm slightly more risk averse than both of you, I think. I'm quite worried about the state of the world economy at the moment. I think we're looking at world GDP growth being something of the order of 2.5%, which is very slow by historical comparison. And within that, you've got quite a number of risky areas. Brazil, for example. China's slowing, but there are still opportunities there. And of course, the Eurozone is performing much below trend, not helped, of course, by Brexit, which is not the most welcome development.
But I mean, what do you invest in?
I think you have to find defensive stocks and I guess some emerging markets. And the most important thing is, as Valerie said initially, to be very selective as to where you choose to buy and which sector you would choose to buy in.
And what about some of the political risks? How big is that?
I think that's one of the paradox. I mean, you cannot understate the political risk, and that will provide for enough volatility. But beyond that, there's also some world coordination. We've seen that since the beginning of this year. The G20 countries are there also to try to coordinate their actions, and that somehow counterbalance nationals' very difficult moment. And I think, and we cannot ignore that, there'll be more of that in the coming months.
I mean, we've mentioned a number of risks. Stefan?
Yeah, so I think the whole Brexit issue is estimated regarding the results for the European economy. In the end, it's not in the interest of the European Union and either not in the interest of the UK to have a lot of burdens in the trade. Both have advantages from the trading. So the UK wants out of the bristle bureaucratics, that's okay, but I think in the end the trades will go forward and further as it was before, and the markets will discover that sooner than later, and then we will have forgotten the decrease and the crash we got after the Brexit.
I mean, I very much hope you're right. I suppose the worry here is that supposing that does turn out okay in the longer term, we could still get both a few political scares, but also financial ones. I'm worried about Italian banks. We've seen some trouble with UK property. Are these big enough to kind of throw things off course?
Well, we're sort of experiencing almost a live stress test, and it seems to be under control by the central bank. But there are some political issues behind that also, and solving the banking crisis in Italy, it cannot just happen overnight. Again, politics behind that is very important. It's under control, I would say. It's not a Lehman moment.
Yeah, it's under the control of Mario Draghi, let's say it like this. So if he wants to take action, so the European Central Bank has unlimited possibilities because they can print money, unlimited, so they can solve all the banking problems.
Christine?
And we've already seen, I mean, Mark Carney has stood up to take action in the UK.
Yeah.
And of course it's clear in the US that they're not going to be raising rates as much and as frequently as people had been expecting earlier. So I think central banks have already moved to try and contain this.
I mean, I hope we're all right. I think the thing that worries me here is we are kind of saying, well, it's the central banks to the rescue yet again. And maybe that is the right answer.
But it's not the only answer.
Yeah.
So I think in the long run, we will have problems, no question. But so in the midterm and shorter run, so I think the world will run as it has been the last years, so the central banks protects everything.
Understood. Well, look, I think we've been round the major issues. We've looked at some of the more optimistic and some of the risks here. Let's now move to the Werthstein Institute vote. So we've all got our iPads in front of us. I'm going to ask each of you, please, to give me a score between 0 and 10. 10 would be really optimistic about the markets, 0 really pessimistic. So, and then we're going to add them up, and that will give us the direction that we feel things are going in. Valerie, could I ask you to begin, please?
Well, Jazz, as I told you, I'm selectively optimistic, but definitely optimist. So that's an 8, really going on the possibilities and looking for opportunities there.
That's a pretty good number, Valerie, pretty impressive. Stefan, what's your feeling about this?
Following my arguments, I have a 9 for you.
A 9, okay.
Yeah, not because I expect enormous growth in the world economy, that's not the point, just because equities are too cheap in comparison to the interest rates to the government bonds.
Christine.
And as you might expect, I've been rather more pessimistic, so I've gone for a 5.
So a little bit of a voice of caution
Yes.
here in the group, and just as well, I think, to balance things out a little bit, I'm going for a 7. So a little bit down the middle. My feeling is there really is a balance of risks here that we have to take. If we put those scores together, we get 29. Well, 29, the Werthstein Institute score, that's not bad given all the risks around. It says there are opportunities here for investors carefully to be looking at. And in the second half, we're going to explore those and see in more detail how you can actually invest.